Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. The stock market today is down 2.5% on the S&P, more than 3% on the Nasdaq, and 1.5% on the Dow. Let's take a look at the different sectors. Well, look at that. They're all red. Let's take a look at the stock market map where pretty much everything is red. So what the heck happened? Well, yesterday I published this video. Deadly stock market crash is just days away. Indicators warn. The day before, I warned imminent crash risk as smart money sells ahead of Fed meeting. In the weekend weekly update video, things were looking a little bit more murky, 50-50 chance of either a monster rally or a crash in the next 3 days. But as soon as we saw the dumb money buy as the smart money was selling, we knew the top was in and the market was going to crash. In fact, here it is. I'm at UTC plus 3. My time zone is UTC plus 3, so 4:40 p.m. is 9:40 a.m. Eastern Time. This was yesterday. Dumb money up top, smart money down below. Divergence complete. Beware, a crash is now just days away. And that's why we booked our profits on both Tesla and AMD yesterday. The Dow is done hitting major resistance line and the 125-day moving average. The defensive rally is over. The Dow has been holding the entire stock market throughout this horrible earnings season, especially as big tech saw profits collapse. In fact, if we take a look at the weekly performance on this stock market map, you will see immediately that big cap tech, Apple, Microsoft, Google, Meta, Amazon, and Tesla saw the biggest losses as the rest of the market was actually chugging along, moving to the upside. This was reflected in the charts. This is the Dow Jones. The Dow Jones had a really strong rally since putting in that bottom on October 13th. In comparison, the triple Qs look significantly weaker. Instead of a big rally, this looks more like an ugly bear flag. In fact, I talked about this in this ratio chart. This ratio chart is for the Nasdaq relative to the Dow Jones. And if we add the S&P 500 on here, we can clearly see, evidently clear. Look at this. Every single rally in this bear market was led by the Nasdaq, outperforming the Dow Jones. Every single one of these, except the last one. And that was the biggest red flag that we've seen year to date. That's why we were exceptionally skeptical as this market continued to move up. Even though we capitalized on it, we called the bottom just a day before it happened. We rode this to the upside with 10 different trades. By the way, in October, we closed 11 trades, 10 of which were profitable. Only one incurred a loss. And in reality, if we had held that position just one day more, we would have actually closed 11 for 11 all green trades for October. Here it is, the market bottoming, massive rally coming. This is the final crash. We called this massive sell-off the final crash. So how did we see this massive sell-off coming? Well, pretty much following the same indicators I've been following for years, which have year to date allowed us to catch every single top and every single bottom. Every single one, year to date, we've caught every single top and every single bottom. And on most cases, to the day, to the exact day we caught the bottom and the top. So how did we do it? Well, this is one of the most important indicators to look at, and it's the smart money and the dumb money divergence. Up top is the smart money, the HYG, the high yield bonds, and down below is the dumb money, the S&P 500. I look at this chart to spot divergences where the S&P makes successive higher highs as the HYG makes successive lower highs. This has marked pretty much every single major reversal and predicted every major sell-off this year. Look at this. Prior divergence in August caught the top exactly. We caught this entire move to the downside. Again, this divergence caught this top and predicted the sell-off. Again, this divergence caught this top and predicted this entire sell-off. We also had positive divergences, including the one that allowed us to trade the June bottom, another positive divergence that allowed us to trade the September bottom, and another one that allowed us to call the October bottom to the day and move to the upside. Another one was the dollar index. Again, in the last two videos, I called this interesting formation, and it's pretty straightforward. When the dollar bottoms and it prints two big green candles, usually that predicts the top almost to the day. Right, this happened back here. The market bottomed, had a reversal candle, another major green candle. The market topped pretty much the next day at the open. The exact same thing happened here. bottom right here, two big green candles. The market topped a day later. Exact same thing here, two big green candles after a bottom. The market topped right here the next day. Another indicator is the Dow theory chart. This is the Dow theory chart with the Dow Jones Industrial Average up top and the Dow Jones Transports down below. Bearish divergences between these two indices predicts sell-offs. In fact, these divergences pretty much called every single sell-off this year. It called the top right here, where the Dow Jones Industrial Average put in a higher high, and the transports completed a bearish divergence by printing a lower high. Then we had that massive sell-off in early January. Again, double top with a higher high, double top, lower high, sold off. This massive divergence predicted this entire move to the downside. Another divergence right here, which warned us that the May bottom was not the bottom at all. And then again, we had that big sell-off in June and the bottom in June. And we're now seeing another major divergence that I warned about in the last couple of videos. And we're now seeing that break to the downside. So what did exactly happen today? Look at this enormous red candle. Well, today was the FOMC meeting, and we were warning for weeks now, really since that article came out on October 21st by the Wall Street Journal. I'm talking about this article in which the Wall Street Journal started a rumor about the Fed potentially pausing or pivoting, reigniting that pivot hopium that actually drove the market up in August and July. Now, as soon as we saw that article come out, we actually closed all of our shorts and we went long again because we knew exactly what was happening. It was a classical stock market manipulation move by the Wall Street Journal. And look how it ended. Just look at how it ended. That's really all you need to know at this point. Manipulation is real, it exists, and it hurts retail traders. Here's what ended up happening today. No pause, no pivot. In fact, Jay Powell said it's very premature to talk about a pause, which is Fed speak for don't buy stocks yet. Just don't buy, not yet. We're not ready to pause, we're not ready to pivot. And the market completely collapsed right after Jay Powell said that. In fact, this played out exactly as we feared yesterday with this fake out rally after the FOMC rate hike decision. And as soon as Jay Powell came on the podium and started to talk and said, oh no, we're not ready to pause yet, that's premature, boom, that's all she wrote. The market crashed. So where do we go from here? Well, for the NASDAQ, we do have a very obvious target, which is this gap fill level at $260. Let's take a look at the 2-hour chart. It's a very obvious level. Look at this double top, ugly double top with a massive negative divergence, a lower high on the PPO, massive waterfall sell-off, and this will likely continue, especially as we've now taken out this $267 level. This was significant support. We now have no real support all the way down to $260 for the NASDAQ. We had the same really ugly double top formation on the PPO in the S&P 500. Look at this triple top with successive lower highs on the PPO. We had this very obvious double top. We had this fake out rally, gap up in the morning. The market sold off. We actually closed our positions in both Tesla and AMD that morning and booked our profits. And all I did since then was just hold my triple Q puts. That's all I did. And they're now deep in the green. The writing was really on the wall. And right now, really, the next level to look at is right over here at $364. There's a lot of trading at this level, and I suspect that this will now act as support. We'll have 270 acting as support. Once we take that, we'll have 365. If we take out $365, the likelihood of this low holding will dramatically decline. Another warning sign that we were looking at was the VIX pausing, moving sideways for 4 consecutive days now. Even as the market was trying to rally the prior 3 days, we saw the VIX pausing. It did not want to go any lower. This was a logical support level that I talked about in the prior 2 videos, 25.5. And we will now very likely begin to bounce back up. The dollar now has bottomed and it now has printed a bullish hammer candle, so expect more pain as the dollar moves up. The NASDAQ especially will be very hard hit. If we take a look at yields, yields have also now printed a hammer candle, 2 in fact hammer candles. and the 10-year yield will likely try to move back up all the way to retest the high of 4.25%. Another key ratio chart that I wanted to talk about was this. This is XLY, consumer discretionary, divided by XLP. And this is a key chart to look at if you want to gauge if the market is risk on, meaning moving to the upside, or risk off, meaning moving to the downside. Now, throughout the rally in the last couple of weeks, even though the S&P was moving up, the Dow was moving up, this ratio was actually very weak, forming a bear flag that I talked about that eventually broke down as we expected, and it just continued to move down in free fall. We had this short-lived bounce. As soon as we saw this ratio attempt to bottom, we actually positioned ourselves long. We went long Tesla, and then we closed right at the open of this red candle, booking our profits yesterday at the open. By the way, guys, this is what the trading community looks like. This is where I post all of my real-time stock market analysis, as well as every single trade and investment that I make. And as of today, we are 10 for 11 trades in the green for October, and 2 for 2 in November, and I'm now shooting for us in the legendary trading room to break our streak for October with more than 10 straight winning trades. I'm so beyond thankful and so humbled by your support, everybody. Every single legend out there. We now have over 1,200 active legendary members in the trading community, and we are growing super fast. Since the beginning of the year, we have now successfully called every top and every bottom. And they say timing the market is a fool's errand. Well, that's because they don't have a time machine like we do. Let's keep the legend alive. Thank you so much, everybody. And definitely let's keep the legend alive. The gains room today was full of gains. So many people posting amazing gains. By the way, all of these gains that I'm going to show you are 100% attributable to the traders that took them. I had nothing to do with these. All I did was provide my take on the market, my analysis. And that's really what I'm hoping to achieve with this community, is to make it possible for every single retail trader to make it on their own, making their own trades and building on sustainable and consistent profitability by having access to timely, accurate, and actionable stock market analysis. Now, I do share all of my trades and investments, and just as I said, 10 for 11 in October, 2 for 2 in November so far, and hopefully we'll go even beyond that this month. But seeing you guys as retail traders making your own money, your own trades, and building your own wealth, that's way more satisfying to me. And it honestly just really makes me happy. So I'm going to run through these very quickly. 170% on SPY puts today. Another one right here. This legend actually told us that he joined the trading community with 1,000 euros. As of today, he more than doubled his account. Incredibly impressive. He started with 1,000 when he joined the Discord group, and he's now more than doubled his account. Absolutely amazing. Congratulations. I'm not going to read all of these, guys. Just pause the video if you're interested. This legend made 30%. This legend made 60%. This legend made over 180%. Another legend right here over 100%. Another legend here with over 93% in gains just today. And another legend with over 180%. A quick round of applause for all of these amazing legendary trades today. Congratulations, everybody. Absolutely terrific, amazing, impressive. You have all earned it. And here's to even more gains for November. By the way, guys, the link is in the description to join if you're interested. It's $30 a month if you go for the annual membership. That's the best value in my opinion. And you will learn so much just by being in this community and learning from all of the incredibly talented traders. In my opinion, what is bar none the absolute best group of traders that I've ever seen in any community anywhere. Now let's quickly jump to the fear and greed index. We were at greed and we're now at neutral. We got rejected just below the 125-day moving average. Stock price strength is now declining. The McClellan volume summation index is a lagging indicator. I talked about this in the prior video. I do have a much more faster reacting and significantly more accurate indicator that I like to talk about, and it's the percent of S&P 500 stocks above their 200-day moving average. By the way, you will find links to all of my charts in the trading community. Put to call ratio, I talked about this head and shoulders formation with a small double bottom right over here, and we're now moving back to the upside. Expect this ratio to shoot to the upside as we continue to see more selling. Market volatility flat it will now start to move up to the upside significantly. Safe haven demand is now significantly growing with bonds outperforming stocks. The yield spread between junk bonds and investment grade is now shooting to the upside as hedge funds dump junk bonds and risky assets. In terms of economic events, everybody, tomorrow we'll have the balance of trade, initial jobless claims, as well as the ISM services PMI, and an OPEC meeting. So a lot of volatility could come tomorrow. But the most important figure this week is going to be the unemployment rate coming out on Friday. If this figure ticks below 3.5%, if we see 3.4 or lower than that, this will trigger another significant major sell-off in the stock market. The week after that, everybody, will have our CPI inflation rate on November 10th, and the market will likely continue to sell off right up until November 10th, and we will either establish a new uptrend after this CPI reading comes out, or we'll establish an even steeper sell-off. Really, between Friday and next week, nothing can save the market, especially if that unemployment rate comes below 3.4%. That's all I have for you today, guys. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.
Oh, wow.